Foreign investors are selling Indian stocks. The same foreign investors are buying Indian bonds. At the same time, with the same money, most coverage treats these as two separate stories. They are not. They are one story. Here is the setup. On the 15th of July, foreign portfolio investors were net sellers of Indian equities. Meanwhile, the 10-year government bond yield has been drifting down. It sat near 6.79% in mid-July, down about 8 basis points over the previous month. Now, a falling yield means a rising bond price. Rising price means someone is buying. So who is buying? Largely the same foreign money that is selling the shares. This is not sentiment. Nobody woke up and decided they like India less. This is plumbing. Somebody changed a rule and the money moved through a different pipe. Today we open that pipe. First, the numbers. The India 10-year government bond yield was around 6.79% on the 14th of July. That was up about 6 basis points on the session, but down roughly 8 basis points over the previous month, and still about 47 basis points higher than a year earlier. Hold those 3 timeframes in your head because they tell 3 different stories. Year on year, yields are higher. That is the slow story. Month on month, yields are falling. That is the new story. And that reversal is what we are here to explain. Now here is the thing about a government bond. The coupon is fixed. It never changes. So the only way the market can reprice it is through the price you pay. Pay more for the same fixed coupon and your yield falls. Pay less and your yield rises. Price and yield move in opposite directions. Always. This is arithmetic, not opinion. And one more piece of vocabulary, because it will come up constantly. A basis point is 1/100th of 1%, so 47 basis points is 0.47%. It sounds like rounding error. It is not. On a government bond market measured in lakhs of crores, a few basis points is an enormous transfer of value. That is why bond people talk in basis points and equity people talk in percent. The bond market lives in a narrower band, so it uses a finer ruler. So when you read that Indian bond yields are falling, translate it immediately. It means demand for Indian government paper is rising. The question is only ever, whose demand? To answer that, you need one piece of plumbing, the fully accessible route. Everyone calls it FAR. Normally, foreign ownership of Indian government debt runs into ceilings. There is only so much of it outsiders are allowed to own. FAR is the exception. Under FAR, non-resident investors can buy specified Government of India dated securities with no investment ceiling at all. No cap, no queue, no quota. Think of the bond market as a stadium with limited seating. FAR is a section of that stadium with the seat limit removed. And notice what a ceiling actually does to a buyer. If you are a large foreign fund, a ceiling is not just a limit on size. It is a limit on your exit. If the section is nearly full and you need to sell in a hurry, the only buyers are the handful of others already inside. Remove the ceiling and you have not only made room to buy, you have made it easier to leave. And counterintuitively, that makes people more willing to come in. Liquidity attracts capital more reliably than yield does. Now, the second piece. In its June 2026 policy, the Reserve Bank widened that section. It brought all new issuances of 15-year, 30-year, and 40-year government securities into FAR. That matters more than it sounds. Long-dated bonds are what pension funds and insurers overseas actually want. They have liabilities stretching decades out, and they need assets to match. So the Reserve Bank did not just make the section bigger, it stocked it with exactly the products that the largest, stickiest foreign buyers need. Now the actual wedge, the thing that moved the money. On the 5th of June 2026, the government promulgated an ordinance amending the Income Tax Act. It exempted foreign portfolio investors from tax on interest income and on capital gains arising from the sale, exchange, or transfer of government securities. And it made that exemption apply retrospectively from the 1st of April 2025. Read that again, because this is the whole video. The tax on that income did not get lowered. It went to 0. Here is why that is so much bigger than it sounds. A foreign fund does not care about your headline yield. It cares about what it keeps after tax in its own currency. If a bond yields 6.8% and the tax on it disappears, the yield the fund actually keeps just jumped without the bond moving 1 basis point. The asset did not change. The arithmetic around it did, and the money responded immediately. In a single 4-day stretch after the announcement, foreign investors put roughly 11,026 crore rupees into these securities under FAR. The 10-year yield softened by close to 10 basis points in the 4 days following the tax exemption. Now hold that against the equity side. Nothing changed for the foreign investor holding Indian shares. Dividends are still taxed, capital gains are still taxed, so you have two doors into the same country. One door just had its toll removed, the other did not. You do not need a view on India to predict which door gets crowded. That is the whole divergence. Foreign money is not leaving India, it is re-entering through the cheaper door. So what does this actually buy the country? An Ecowrap report from the State Bank of India's Economic Research Department estimated that the central bank's recent measures could help India attract 55 to 65 billion US dollars in inflows in the current fiscal year, stabilize the rupee, and push the balance of payments into surplus. Treat that as an estimate, not a fact. It is a forecast, and forecasts miss. But look at the direction, because the direction is the point. Dollars coming in to buy bonds are dollars sold for rupees. That is direct support for the currency, and the report framed the February and June 2026 measures as one coordinated attempt: stabilize the rupee, deepen the domestic debt market, attract more stable foreign capital, and reduce friction for external funding. That word stable is doing a lot of work. Equity money is fast money. It leaves the weak the mood turns. A pension fund that bought a 40-year bond is not trading out on a bad headline, so the trade being made here is not really stocks for bonds. It is fast foreign money for slow foreign money. There is a second-order effect worth naming. When foreign money buys long-dated government bonds, it competes with domestic banks and insurers who are the traditional buyers. That lowers the government's cost of borrowing at the long end, and the long end is the anchor for almost everything else priced off it, from corporate bonds to project finance. So a tax change aimed at the currency, it ends up quietly touching the cost of capital across the economy. That is what people mean when they say the debt market is plumbing. It is not glamorous, and it is underneath everything. And you can see the supply side too. On the 10th of July, the Reserve Bank auctioned 32,000 crore rupees of government bonds, including a 6.36% 2031 paper and a 7.71% 2066 paper. That second one matures in 40 years. 40-year paper only exists if somebody out there wants to own it for 40 years. So, one line to keep: capital does not have loyalty. It has arithmetic. Nothing about India's growth story changed on the 5th of June. One line in the Income Tax Act changed. The tax on foreign holdings of government securities went to zero, backdated to April 2025. The Reserve Bank widened the fully accessible route to take in 15, 30, and 40-year paper, and the money rearranged itself around the new arithmetic within days. Roughly 11,000 crore rupees in 4 days. So the next time a headline tells you foreign investors are fleeing Indian markets, ask the only question that matters. Fleeing which market? Because on the 15th of July they were sellers of Indian equities and buyers of Indian government bonds. Same investor, same country, same day, opposite direction. The flow did not follow a feeling, it followed a tax code. That is analysis, not advice. We do not tell you what to do, we show you how the machine works.